Good morning from our global headquarters in New York. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. Throwing cold water on the Fed put. As tariffs take hold, Chair Powell hints that inflation is the #1 concern. Big progress in Japan. The president touts trade talk momentum. Next, Italian Prime Minister Meloni heads to D.C. And earnings season kicks into high gear. TSMC beats estimates. Up next is Netflix after the bell. Aren't you happy it's a holiday-shortened week? It is the last day of trading after 3 consecutive days of losses. An ugly day yesterday that started off the back of chips selling off of Powell's speech, which suggested that a Powell put remains well out of the money. We try to come back today. It is the trade talks in Japan going well. Relief rally. NASDAQ 100 futures lead those gains, up 0.8%, 0.7% for your S&P 500 futures. Similarly, Treasuries also gained for 3 straight days. That eases this morning. Your front-end yield up 4 basis points. It's called 3.5 for your 10-year yield at 4.33. It was the front end that suffered the most yesterday as we priced out further odds of a Fed cut. Those are your overall markets. Let's get some stocks to watch. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So TSMC bringing some well-needed positivity to the chip space today after a difficult day yesterday. We can see the ADRs on Taiwan Semi up around 3.7% at the moment. $29 billion in revenue expected in the quarter, more than analysts expected. However, downplaying talks of a potential joint venture with another company, and that is hitting shares of Intel in the pre-market. We're seeing that one a little bit lower today. There, we've got that price on the screen there. We're down around 2% on Intel at the moment. Then take a look at Alcoa, a little bit weak in terms of some of the impact of the declining aluminium price on the company's forecast that they gave last night. So that one down 3% in the mining space. And then finally, check out Hertz, up again, rallying following that huge gain yesterday as Bill Ackman's Pershing takes a stake in the car rental company. Very powerful move from Ackman on that one. All of this available on the before the opening bell wrap on the terminal, Danny.
Joe, great work as always. Bloomberg's Joe Easton there. Coming up on the show, we're going to be speaking to George Saravelos of Deutsche Bank, and later in the hour, Rob Casey of Signum Global Advisors. Now, in his latest report, George Saravelos looks at just how overweight the world is in U.S. assets. He found that Japan's holdings of American assets have doubled since 2010, while in Europe, the figure has quadrupled. He writes, a sustained shift in foreign investor U.S. dollar allocation closer to historical norms has the potential to generate huge negative dollar flows. I'm pleased to say that George joins us now. George, again, just such fantastic work you've been doing over the past couple weeks. And this study in itself is really interesting. So we have to ask the question, are we getting that now? Are we getting a sustained and structural shift towards something that looks more like what was the norm?
Thank you very much for having me on the show, Danny. I think it's very early days, of course. We're still only a few weeks away from the very big announcements from President Trump at the start of the month. And I think only time will tell if these big shifts will happen. But our view is that the preconditions are being set for these shifts. On the one hand, you've got a general weakening in the U.S. economic outlook. This is on the back of all the policy back and forth, worries from the market around bigger fiscal tightening. And then the second driver, which is a bit more structural, is this challenging of all those post-World War II norms, which the world has known, U.S. leadership in terms of the global trading rules, the global geopolitical rules. And to the extent that leads the market to reassess how willing it is to hold such a large portion of its global assets in the U.S., that could also start some of that unwind. So we're very cautious in making big, bold predictions given how things are changing. But I would say if the probability of some of these bigger capital flow shifts is going up.
Hey, I mean, companies in this environment aren't even willing to give their outlook for the year, so I understand not wanting to forecast and what things look like in years from now. But, George, there is a difference between just diversifying outside of U.S. assets versus a real threat to the dollar as reserve currency status. How do you distinguish the path that we're heading, in which way it takes, whether, again, it's just diversifying, getting back to something normal, or a true threat to the dollar and what it represents?
That's a great question, Danny. I think in real time, it's very difficult to distinguish between the two. I would say probably the key variable in trying to see whether we're seeing a very sharp disinvestment of US assets is just the level of volatility and the sharpness of the moves. And the market was worried about such a sharp divestment last week. So number one is just the level of volatility, which has since calmed down. And number two, and this is absolutely critical, is the relationship between fixed income and the dollar. And if you're in an environment where yields are going up and the dollar's weakening at the same time, that points to a much more disorderly market dynamic. Now, are we going down that route or not? Is the route going to be more orderly? I would say at the core of whether this happens is how extreme is the US policy mix. If the market perceives the US is going down a very extreme policy route, and by extreme, I'm referencing extreme levels of tariffs, I'm referencing a challenge to Fed independence, large additional fiscal easing with deficits already being very wide. If the policy mix ends up being very extreme, then the probability of more extreme capital flow developments goes up. And I don't think it's by chance that the reason the market stabilized over the last few days is precisely because the Trump administration stepped back from some of the more extreme tariff policies.
Even if we don't get the extreme scenario, George, but one that still does assist this rotation out of U.S. assets, does it imperil a treasury market that is ballooning in size and becoming more dependent on ever than foreign buyers to fund it?
That's another great question. And at risk of oversimplifying, if I think about the global financial system over the last 20 or 30 years, the core has been the following transaction. It has been the American consumer essentially buying European and Japanese cars in exchange for selling treasuries. That is at the core of the global imbalance, so to speak, over the last few decades. And I think the US is going down a route of wanting to change that. And it's been focused on wanting to change the trade imbalance. But the two go hand in hand. If you've got a trade imbalance, it must mean someone is funding those deficits. And I think the risk that seems to be materializing is that by challenging these global alliances, by changing the rules of the game on trade, the market is changing its perception and its willingness to fund the other side of that ledger, which is the capital account and treasuries. So I think it is a risk. It most certainly reduces the scope of fiscal space in the US. And again, it goes back to how extreme and confrontational our policy is going to be. If you're down the route of negotiating, as we're now seeing with the headlines around Japan, it makes the world a bit more comfortable. But if we go down the route of disruption, then you may apply tariffs, but then that leads the market to question the funding of the deficit, and then you lead to the more disorderly dynamics.
Okay, that brings us to another question then, George. If that all is the case, does this just end up on the Fed's balance sheet? Are we headed towards QE infinity yet again?
You're right that it all ends up being part of the same story. I do think if you're in a situation of outright market disruption, and I would call that a sudden stop of capital, which the market was fearing to some extent last week with the Treasury sell-off, then the Fed would have no choice but to intervene. And here we should understand that as a market stabilizing role rather than a monetary policy easing. Remember, during the crisis in the UK a few years ago, we had the Bank of England still on a hiking cycle, but they did intervene to absorb the gilt selling that was taking place. So I think in that extreme scenario, we should be expecting the Fed to be intervening. Now, what is the ultimate impact of that on the dollar? Well, it depends on the broader policy picture, because if the Fed is intervening, and the US policy mix is stepping back and becoming more conventional, so to speak, then that should help stabilize things. But if the Fed is intervening in the context of policy staying very extreme, then that could potentially lead to an even more an even bigger drop in the dollar in the context of the overall policy mix.
Well, George, to that point, I can't let you go without getting your thoughts on Powell yesterday, saying without price stability, we cannot achieve long periods of strong labor market conditions, essentially saying that it is the price stability which is more important than unemployment at this point. To your point of what you were just saying, in terms of if the Fed is intervening, it is something about stability. It is something about these markets. Do you just assume that this is a Fed that will need to sit on its hands for the time being?
I think as far as monetary policy goes, that's true because we've still got a tremendous degree of uncertainty. And remember, there's uncertainty on tariffs, but there's also very large uncertainty on the budget negotiations that are taking place in the US. I can come up with very different inflation scenarios depending on how US budget negotiations go. Imagine a world where all the tariff revenue is used for stimulus paychecks, for example. That's a completely different monetary conclusion to one where you get a large fiscal tightening. So it makes sense, I think, for the Fed to be on hold. But I'm also not surprised that the Fed and Chair Powell was very much emphasizing this question of Fed independence, because this is also at the core of keeping the bond market stable. And if we're thinking about tail risks outside of tariff policy, I would definitely say this question of Fed independence, especially in the context of some of the Supreme Court decisions that the market is awaiting over the next few weeks, this question of the Fed independence is very important for the market.
George, such an important conversation and fascinating as always. Wonderful to have you on. George Saravelos of Deutsche Bank, please come join again soon. Okay, coming up on the show, big progress. That's how President Trump describes trade talks with Japan. We'll have the details for you next on your Bloomberg Brief.
The strategy of President Trump is a strategy, in my opinion, against globalization, and that is a problem for us.
That was the former Italian Prime Minister, Matteo Renzi, speaking to Bloomberg earlier today. Now, the current Prime Minister, Giorgia Meloni, is in Washington to meet President Trump to talk trade. In the meantime, a delegation of Japanese trade officials were in Washington this week. President Trump met with them yesterday and said there's been, quote, big progress, a lot to unpack. Our team coverage starts now. Bloomberg's Brendan Murray, who leads our global trade coverage, joins us. And from Rome, Bloomberg's Alessandra Migliaccio. Brendan, let me start with you and this supposed big progress being made with Japan. What do we know?
Yeah, so the Trump administration tells us that there are dozens of countries that want to come to the negotiating table. So Japan is the first one to arrive, and it's important for both sides to show that there's progress being made, regardless of the fact that we didn't get any details about what that progress was. But I think what you're seeing here is Trump trying to set the optics for these negotiations to show that this isn't a Zelensky in the Oval Office. White House that the country's trading partners are dealing with, and to hopefully in their view to bring other countries to the table. South Korea is coming next week, India a couple weeks after that. So the tone from the Trump administration is very much rolling out the red carpet for a close trading partner like Japan, and some optimism that a deal can be done in the next couple months.
Rolling out the red carpet for Japan, but does Meloni get the same treatment, Alessandra, given some of the back and forth we've seen between the EU and the U.S.?
Well, I guess that's what she hopes. Meloni is, let's say, ideologically in line with Trump a little bit. So she sort of hopes that she can be the bridge between the EU and the Trump administration. Of course, it's a risk. A lot of her EU partners have warned her that it's a risk. They've warned her that it's maybe not a good idea to go it alone because, Trump has shown contempt for the EU and a desire to split it up, to speak individually to countries. And of course, that's not possible because on trade, it's the EU Commission that deals with these matters. So we'll see what happens. There is some optimism. She did speak to Ursula von der Leyen. She did speak to the EU saying, I am going for you. I'm not going it alone. So there's some optimism that she can sort of find a way to speak to Trump and be a Trump whisperer for the EU.
There's a question of who's doing the talking from the U.S. side. Brendan, we know that the ultimate decision comes down to one person. and that is the president. But there seems to be a desire to get the Treasury Secretary more involved in these conversations. Do we know who is leading at this point?
Yeah, exactly. That's one of the conditions that China has set for it to come to the negotiating table. Is who's the point person? We hear Treasury Secretary Bessent say that he wants to make a deal, and there are deals to be made. But then you listen to other trade advisors like Howard Lutnick, who says who will tell you that tariffs are here and they're here to stay, regardless of how the negotiations go. So it's interesting to see the Italian leader in Washington today. The week started out with the European Union's trade team talking with Howard Lutnick and the USTR Jameson Greer. They walked away from that meeting scratching their heads, thinking they don't know what the U.S. wants out of these negotiations. So it's an interesting contrast that we're seeing between the European Union's trade team and the Italian leader trying to break through in some way on a personal level, at least with Donald Trump.
Well, how much unity is there in Europe right now, Alessandra, for Meloni to go in there? Because we've heard varying accounts from Ursula von der Leyen in terms of how they respond, whether it's one of negotiation, whether it's one of pressure being put on. Is Europe coalescing around Meloni as its Trump whisperer of sorts?
At this time, not really. There was actually, I was recently in Warsaw for the finance ministers meeting over the weekend, and there was doubt that this was possibly not a great idea. But she did speak to Ursula von der Leyen. I think they've found an accord. They will let her try this. She said she's going for the EU. She's not going it alone. I think at this point, the attitude is more like, what, if it works, good. Because it's very hard to know what Trump will do. It's very hard to know what will happen. And I think Meloni she's very intelligent. She knows what she's doing. She's really trying to just boost her own role, but at the same time, do something useful. The problem is, again, Trump is unpredictable. So it's a big risk she's taking, and, we'll have to see how that pans out.
Brendan, let me just give you the last word, because we had the timeline of 90 days to get deals done. I think we're something at like 84 days away from that deadline now, with something like 75 trading partners. Just how monumental is the task ahead for this administration to get those deals done?
Yeah, I think it depends on how you define a deal. Some sort of commercial arrangement where a country buys more natural gas and kind of those kinds of things. But in terms of redoing trade deals, free trade deals, those take months, years, to hammer out. And even the Treasury Secretary said these will most likely be agreements in principle rather than full-fledged free trade deals. So I think there's some optimism that a few deals can be done, but I think the expectations ought to be tempered about just how monumental those will be. They're more likely to be moderate than monumental.
Brendan, Alessandra, thank you so much for your contributions and work this morning. Bloomberg's Brendan Murray and Alessandra Migliaccio there. Coming up on the show, the IRS is said to be considering taking away Harvard's tax exemption. We'll have more on the administration's attempts to choke off Harvard's federal money. That's next. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at what's on the front pages this morning from different outlets around the world. First up, the FT is leading with Chair Powell saying that Trump's tariffs are likely going to put inflation goals and the Fed's job in conflict and at risk. Powell spoke at the Economic Club of Chicago yesterday. He also said that the president's tariffs announced so far have been significantly larger than anticipated, sort of painting a stagflationary type of environment that keeps the Fed unable to cut. Next up, the New York Times leading with the IRS weighing whether to revoke Harvard's tax exemption. An IRS spokeswoman declined to comment to the Times. Harvard then pushed back in a statement saying that the move would be unlawful and there's no legal basis for doing so. Finally, the Washington Post leading with the Trump administration seeking to slash budgets for federal health programs. According to a prelim budget document seen by the Post, it calls not only for cuts, but also a major shuffling and restructuring of health and human services. Coming up, trade negotiations are underway in Washington. Rob Casey of Signum Global Advisors will join us next on your Bloomberg Brief. from our global headquarters in New York. Welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Throwing cold water on the Fed put as tariffs take hold, Chair Powell hints that inflation is the #1 concern. Big progress in Japan. The president touts trade talk momentum. Next, Italian Prime Minister Meloni heads to D.C. And earnings season kicks into high gear. TSMC beats estimates after the bell, Netflix reports. Aren't you happy it's a holiday-shortened week? It's the last trading day of the week, and we look to break 3 consecutive days of losses. It was an ugly day yesterday off the back of chips selling off the back of a Powell speech, which suggested that the Powell put remains far out of the money. We gained some 1% on the NASDAQ 100 this morning, same for S&P 500 futures. It is the trade talks going while relief rally. For your bond market, we're also snapping 3 straight days of gains. For the Treasury market, up 4 basis points, just thereabouts for your 2- and 10-year yield at 4.31 this morning. Let's get underneath the surface with some stocks to watch. Is Bloomberg's Joe Easton. Good morning, Joe.
So TSMC looking pretty strong in the pre-market trading on the ADR. Danny, we're up around 3.3% at the moment. The company projecting $29 billion in revenue for the quarter. Not too bad despite those trade war issues for the company. But separately, they are downplaying talk of a partnership with another company. And that is hitting Intel this morning because it had been speculated that the two companies would team up on a venture. And we can see Intel coming down 1.8% in the pre-market. Then we've got Alcoa in mining, the old bellwether from that sector, looking a little bit soft on some of their aluminium projections. We have seen the base metal prices coming down recently, and we can see Alcoa slipping in the pre-market. And keep an eye on Hertz, once again surging as Bill Ackman takes a stake in the car rental company. A second day of gains following a 50% move in that one yesterday. Set to continue that huge rally, Danny. Keep an eye on Hertz in the pre-market this morning.
Joe, thank you very much, despite the fact you almost called me Dowie, but I'll take it. A Dowie rally. Joe Easton there.
It's been a long week.
Bloomberg's Joe Easton. It's basically Friday. It doesn't matter. So anyway, back to our top story. Trade talks are underway in Washington. President Trump says that there's been big progress in talks between the U.S. and Japan. Next up, Italian Prime Minister Giorgia Meloni, who's in Washington now, will also discuss trade with Trump. Joining us now is Bloomberg government reporter Jonathan Tamari. Jonathan, what do we know about the big progress that's been made with Japan?
Yeah, both sides put out very positive sounding statements yesterday after Japan's lead negotiator had a meeting with President Trump and other officials. They both sound like they're moving in a broadly positive direction, but nothing is finalized yet. And I think if you talk to the Trump administration, they would say this is the plan all along, that they were going to force people to the table and get better deals for Americans. I think the lingering concern is going to be that how many deals can you really do within these 90 days before the full tariffs kick back in? And is there a systematic process here? Is it just going to be kind of country by country?
So far, it looks like something akin to country by country, yeah. Jonathan. What should we expect out of Meloni's visit today? Yeah,
it's another one where I think the president often operates based on not necessarily international relations, but more his personal relations with people. And Meloni has a lot of ideological similarities to Trump. So I think that's something that she will probably play up and hope that she can get a good deal for Italy. And I think a lot of Europe is going to be watching to see how this works out because she's one of the leaders in Europe that I think might have the best or the closest affinity or most similar relations to Trump. So if she can get a deal, that might be a positive sign. If she can't, it might be pretty concerning to people who are less close to the president.
Jonathan, thank you so much for your reporting this morning. Jonathan Tamari of Bloomberg Government. For more on trade talks, pleased to say that Rob Casey, partner and senior analyst at Signum Global Advisors, joins me now. Rob, great to see you. Thanks so much for coming into the studio this morning.
Of course. Morning, Danny.
So, okay, the market trades basically on every trade headline. We're excited this morning that there's big progress with Japan. How much confidence can you take in that?
You know, I don't think a lot of confidence. And I say that because the President Trump's team has to strike, 60-plus deals over the course of the next, not even 90 days now, right? 80-some days. So, we hear progress on Japan, and we expect to hear progress on the UK. Beyond that, I just think it's probably too much to do in 3 months. And so we do expect to see, more negative headlines as we get out to that July 8th date.
Does that mean as we get to July 8th, we might see more delays to the delays of trade talks? If the Trump administration has this huge task of kind of getting deals done with 75 different trading partners.
Yeah, I think we could see more delays, but I think that honestly, the scarier idea and what we think is, base case expected is that we will actually see some of these tariffs put back on July 8th, right? I think the point we're making to clients, and it's an important one, to your point, stocks are up and down depending on even the most minute headlines around these trade talks. But I don't think we can forget that in President Trump's first term, he canceled tariffs on steel and aluminum only to put them back on later, right? So we're not out of the woods. A cancel or a delay, right, a pause is not necessarily a cancellation.
Yeah, fair enough. Something important to keep in mind. But it also feels like everybody wants Scott Bessent in the room for their trade negotiations. China talking about a point person, you'd have to assume that maybe that's who they're speaking about as well. Do we have any idea as to who is actually leading on this front, whether Scott Bessent has become the proverbial adult in the room leading these conversations?
Well, I think he's definitely the adult in the room. I think he probably has always been the adult in the room, right? And markets certainly have taken some comfort, really, since President Trump's inauguration, in that Bessent is in the room. Now, I think there have been moments where Peter Navarro, Commerce Secretary Lutnick, they have been the loudest voices in the room. But I think since, the unwinding of Liberation Day, it does feel as though Scott Bessent is in the driver's seat, right? That's not to say he'll be in the driver's seat forever, and there's sort of this Kremlinology or White Houseology about who is the last voice in the room, who is the loudest voice in the room. I think that the truth of the matter is there is not going to be one consistent final or loudest voice, but for the time being, it does seem to be Scott Bessent.
Again, that just kind of leads to the volatility. And I wonder when you hear from these various cabinet officials, whether it be Lutnick, whether it be Bessent, speaking with Bloomberg's Anne-Marie Horduran this week, whether you look at them as spokespeople actually for the administration or almost just kind of wish casting what they want the policy to be. How seriously can you take every word that they say?
I think the truth is when you're working for President Trump and you're on television, you're speaking to an audience of one, right? You're speaking to the president. And that's not a knock on any of these folks, any of these secretaries, and it's not a knock on President Trump. I mean, if you take him at his word, what he's trying to roll out is something that the country really has never done before, right? This is bigger than Smoot-Hawley, and that was 100 years ago. So I think it's fair to say that the team is still working through maybe what their strategy will be, what they're going to ask for in trade negotiations. What we don't expect is for them to just take the quick win, right? There's this thesis out there that, since Liberation Day and the turmoil that we saw, in particular in the bond market, now President Trump's team is just looking for quick wins, right? Any trade deal where they get some concessions, they will take. I think that they're going to stand firm and request more and higher concessions than a sort of quick win thesis would indicate.
Well, as that's going on, we've seen some legal challenges start to mount. We had yesterday California, Gavin Newsom, and the Attorney General suing in order to try to block the tariffs. Do you think any of these legal arguments will have legs to them?
I don't think that California's suit will have legs. We haven't seen suits to this point that we expect to have legs. Which is not to say that the suits are bad or poorly written or poorly argued. It's just to say that IEEPA is very vague and very broad, right? And some of these suits, the point that they make is that IEEPA itself doesn't list tariffs, right, as a presidential action or authority. But the fact that tariffs aren't listed is not a reason why the president can't use tariffs under emergency economic power. So the suits that we've seen so far, I would not expect to be successful because IEEPA has been so broad. And just to state, if I'm wrong about that, right, and one of these suits does prove to be successful, the president can just come back the next morning, right, and start a new tariff process through 232, 301, right? There are a number of presidential powers at President Trump's disposal to reapply tariffs, right? So this isn't necessarily a one and done. There are a number of tools he can use. If one gets struck down, he'll just use another.
So the legal system can't necessarily serve as a circuit breaker in here. And the thing that we have seen serve as that has been the market, has been when bond yields went higher. For now, they've kind of been at bay. And there seems to be this idea that the market has regained this confidence that it can indeed push around the Trump administration. Should it be that confident? Do we understand that to be the circuit breaker?
Well, I think pretty clearly the bond market has been, the Trump put so far, right?
Yeah.
It seems as though everybody over the past couple of weeks has been asking, where is the Trump put in the equity market? And I think that the truth is there may not be one until we get to the bond market. So that's what I would start looking at in terms of, response vectors from here. But I will say President Trump, and I think it's probably true that anybody sitting in the Oval Office doesn't like to be made a fool of, right? Doesn't like to stand down from what they had announced, right? So this isn't necessarily just a point about President Trump. I think it's a point about anybody in power. Now that President Trump has had to take one step back, we think it's less likely that he will take a second step back, right? As we get closer to July 8th, maybe this is a moment where President Trump wants to push, right? Maybe push his advantage, maybe push his perceived advantage. And if he does that without having the leverage over other countries that he thinks he does, we could be looking at tariffs on July 8th.
So for big international companies that have to deal with this, is there a threat that they get pushed further away from the U.S.? And I ask this because the FT had a really interesting story out this morning, basically saying that NVIDIA's Jensen Huang is in Beijing right now and that he's been holding talks with the Chinese vice premier. And this, of course, comes off the back of NVIDIA also warning the fact they're going to take this huge charge because of increased export controls from the Trump administration. Is there a risk that we are pushing not even just countries, but companies into China?
I think that there is a risk of that, right? And what we've heard from the Trump team over the course of the past week is actually quite the opposite, right? There's this idea that actually this, the whole Liberation Day, the whole tariff agenda has been meant to pull companies and countries away from China, right? And that is it's a gamble, right? It's a gamble for the United States because there are certainly countries and companies who are as exposed to China as they are to the U.S., if not more, right? And I also think it's a gamble because, if I'm a company or a country, and I think this is new, right? What I'm seeing in the U.S. is instability, and what I'm seeing in China is relative stability, right? So if I'm making those bets, all of a sudden the U.S. doesn't look like, the shining trading partner that it once did, given all of this instability. If we get beyond July 8th and there are still no tariffs on, I think maybe we can get back to, status quo ante, back to normal. But, for the time being, the U.S. does not look like a stable, reliable trading partner.
Well, kind of on the same note, Peter Schiff of Academy Securities has been talking about this idea that the brand of America is tarnished in this. Whether it's this type of volatility for companies, whether it's actions taken against Ivy League schools that are these big beacons of American institution, and it means that abroad the American brand is less attractive in terms of coming over here, in terms of buying goods. Would you agree with that? Is there a threat of brand America?
Well, I think that the brand of America remains strong, right? and President Joe Biden always used to say, I would never bet against the American consumer, the American manufacturer, et cetera. So I think that there still is some of that, right? But I honestly, in this moment, I think that is because there is a lack of a suitable alternative, right? We can talk about how China looks relatively good in this moment, relatively stable for sure. It's stable because it's an autocracy, right? It's stable because it is one man with an iron fist, holding a country at bay. And the U.S. remains a democracy. The U.S. remains a relatively open market. It's easier. It's a little bit, muscle memory to say that the U.S. remains an open market today, which it wasn't last week. But I think that being said, right, there's no obvious safe haven other than the United States. So I think that the U.S. benefits from, nearly 100 years of being way out in front of everybody else. I think we will continue to be way out in front of everybody else, despite this, instability, volatility, because I'm just not sure that there's anybody sort of stepping into that vacuum.
Yeah, it's a very similar conversation we've been having about the dollar, too, and its reserve status.
Yeah.
Rob, thank you so much for coming in early for us. Really wonderful to see you.
Danny.
As Rob Casey of Signum Global Advisors. Let's get you some other top stories that are trending on the terminal this morning. TSMC is keeping its growth outlook for 2025. It still expects mid-20% growth this year, despite tariff uncertainty. It also stuck with its capital spending projection. TSMC expects AI revenue to double. Chinese President Xi Jinping is promoting the idea of a, quote, Asian family, calling for regional unity. It's an apparent effort to counter U.S. pressure on nations to limit trade ties with Beijing. Xi has been touring around Southeast Asia this week, starting with Vietnam, then Malaysia and Cambodia. Hermes shares sinking this morning after the maker of Birkins reported weaker China sales. It will also increase prices in the U.S. by May 1st to compensate for the impact of new tariffs. The company said it hasn't noticed change in U.S. demand trends. So get your Birkin now, I guess is the moral of this story. Coming up, the ECB is expected to cut rates for the 7th time. More on how tariffs are weighing on policymakers in the EU. We go to Frankfurt next. This is Bloomberg. You're watching Bloomberg Brief. I'm Danny Berger in New York. Now to Frankfurt. The ECB is set to cut interest rates for a seventh time, a move that comes after President Trump's tariffs shook markets and darkened the economic outlook. Bloomberg's Lizzie Burden is at the ECB headquarters in Frankfurt. Lizzie, what are we expecting today?
Well, Danny, I'm not going to lie. This meeting was really nail-biting. It was meant to be, but actually now it looks like it's going to be a bit of a no-brainer, especially for most of the Governing Council, at least, because, of course, as you say, Donald Trump's tariffs mean, in the eyes of economists at least, it's going to weigh on growth and inflation here in the euro area. On top of that, yes, we've had this 90-day reprieve on 20% levies on the EU, but the talks, as you were just discussing in Washington this week, haven't yielded much. And actually, the EU hasn't retaliated yet. So the ECB doesn't need to deal with the potentially inflationary impact of that retaliation. There's been this whole debate about whether the fiscal boost to growth would outweigh the tariff threat to growth. But what we've heard from policymakers since the last meeting is, look, one's long term, one's short term. And yes, we need to be vigilant about balancing the two. But what they need to deal with in the here and now is, first of all, this rapid rise in euro dollar and that making imports cheaper, exports more expensive, and then potentially hurting the industrial base, so needing to support growth. Lower oil prices, deflationary, and then on top of that, the chance that China floods Europe with all of these cheap goods to circumvent its own tariffs. So all roads point to a quarter-point cut today, especially, by the way, because you've got inflation comfortably moderating towards that 2% target.
Lizzie, we heard from the Fed yesterday about this concern of unknowingness of what happens if you do have inflation at the time that growth is weakening. For the Fed, it really meant that they are staying on pause, that they're taking their time. What about for the ECB, that path ahead when there is so much uncertainty about what things look like?
Well, yeah, and the fact that Jay Powell has kind of dashed hopes of a Fed put really puts the pressure on Christine Lagarde today, Danny, to calm these markets, especially after everything that happened last week, and especially when you've not got a Bank of England decision this month or a Fed decision. So the focus very much on the path ahead, given that a quarter-point cut today seems pretty much nailed on, and that puts a lot of onus on the commentary around this decision. There is no way, I reckon, that they will drop the language about it being data dependent and meeting by meeting. But what will be interesting is whether they drop this language about monetary policy having become meaningfully less restrictive. They added that on last month, but if they drop it, it would be a hawkish signal, and it doesn't seem like that's something that Christine Lagarde is going to want to send today.
Lizzie, fantastic reporting. Looking forward to your reporting throughout the morning as we get closer to that ECB decision. That is Bloomberg's Lizzie Burden in Frankfurt. Elsewhere, Netflix will be reporting its first quarter results after the bell. Analysts expect the company to weather the macroeconomic climate better than its competitors. Joining us now is Bloomberg Intelligence tech analyst Matt Bloxham. Matt, we also heard from the Journal yesterday, or the day before rather, that Netflix was targeting some pretty big goals in 2030, something like a $1 trillion market cap. Are we headed into an earnings season with a very confident Netflix despite the economic environment?
Yeah, I think we are. Obviously, those kind of 2030 goals are pretty ambitious, and quite a big transformation in what the company is, and particularly with advertising revenue. I think certainly it's going to have been a strong quarter for the company. There's some kind of really good TV launches, particularly Adolescence, which has kind of been a really big success, certainly here in Europe, and they've been extending more into kind of live content too. So, I think it's going to be a strong quarter. Interestingly, from this quarter, they will no longer report subscriber numbers, or average revenue per subscriber, which has also been a massive focus for investors. And I think they're trying to take away the focus on that kind of short-term volatility in those numbers and make people look more at the overall kind of revenue growth, which is probably going to be in the kind of low to mid-teens, about $10.5 billion of revenue the market's expecting it in Q1. And I think Netflix is probably the one streaming platform that the majority of people would be really reluctant to say goodbye to. So I think even to the extent that we get a recession, I think customers are going to hold on to Netflix, and if anything, it may well prompt people, to stay at home more and seek entertainment at home. So I think it could become an even more important part of people's lives, as we saw in the pandemic. So I think, they're in a good spot right now.
Matt, before we let you go, I want to ask you about the chip sector, too, because it was a really rough day after yesterday's news of restrictions to NVIDIA's H20 chips. We heard from TSMC overnight. A strong set of results. How much reassurance can we take from it?
I think some, but not a huge amount. Obviously, they kind of got strong growth in Q1. They're reporting a better than expected outlook for Q2, but the full year sales growth guidance, kind of around 25%, is unchanged. So it's very much a pull forward. People stockpiling before the tariffs hit. And they seem very upbeat about the demand for AI chips. That kind of makes sense for 2025, given all the capex we're seeing going in from the hyperscalers. But the tariff story can turn on a dime, and if things change tomorrow with details of the specific chip and smartphone tariffs that Donald Trump has kind of flagged, then the outlook, and concerns could come back again. So, I think they're doing everything they can. They're a great company, really leading the semiconductor space. But, there's still a lot of uncertainty out there that's going to take quite a while to play out.
Matt, thank you so much. That is Bloomberg Intelligence's Matt Bloxham. Coming up on the show, we're going to wrap up the week with a rate decision and earnings. Congratulations. It's Thursday, but it's also your last trading day of the week. We're going to break it down for you coming up next on your Bloomberg Brief. You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's get you set up for your trading day. The ECB will be announcing its rate decision. That comes at 8:15 a.m., followed by a news conference by Christine Lagarde at 8:45. Plus, American Express results come before the bell. Netflix, meanwhile, is after the bell. And markets are closed in many countries for Good Friday tomorrow, including the U.S. So enjoy this, the last trading day of the week. You are looking at equities attempting a rebound after a sell-off yesterday, first led by chips, and then Powell talking about inflation as the number one concern. U.S. futures up about 0.8%. All right, that's it for your Bloomberg Brief. Surveillance, take the reign from here.